Breaking news, a sudden U.S. trade policy shift is slamming semiconductor stocks, with a 20% tariff hike on key Chinese imports, and it matters to your portfolio right now because it's already moving markets.
The lab's position: this is a high-risk, high-reward inflection point.
The impact is clear. Qualcomm, with a lab score of 35, is a cautionary buy due to its significant exposure to Chinese manufacturing and a verdict of caution, as the engineering is sound but geopolitics are uncertain. Micron, with a lab score of 58 and a verdict of hold, will see supply chain disruptions, particularly in its HBM3E stack production. Conversely, Intel, with a lab score of 61 and a verdict of buy, is poised to gain from the policy shift, riding the waves of its strong hardware portfolio. The lab will dissect the chain reaction in full, from engineering teardowns to geopolitical maps, and deliver a final verdict, so stay locked in. The next hour will be crucial. Qualcomm Incorporated closed down 0.38% today at $126.80, not because of sentiment, but because the Snapdragon 8 Gen 4 7nm and 4P die hit a hard silicon wall. 128mm superscript 2 at TSMC and 4P with a 15W TDP. Thermal design power: the maximum heat a chip can dissipate before throttling, and it's still power hungry.
That's the engineering ceiling.
The Snapdragon 8 Gen 4 isn't just a phone chip, it's a 5G modem, CPU, GPU, and AI engine all fused into one reticle, and 128mm superscript 2 is the practical limit before yield drops below 75% at TSMC's CoWoS, chip-on-wafer-on-substrate packaging, the interposer that holds multiple dies together, line in Tainan. Anything larger in Qualcomm's gross margin, 60% on mobile chips, starts bleeding red.
Compare that to Apple's S17 Pro at 102mm superscript 2 on TSMC's 3nm N3E process, 30% smaller, 35% more efficient.
Apple's die is lean because it outsourced the 5G modem to Qualcomm, but now Apple is bringing the modem in-house with the A18 Pro. That's a 20% revenue hit to Qualcomm's mobile division, and the market is pricing it in today. Visual: Qualcomm die architecture versus competitor side-by-side. B-roll: wafer fabrication cleanroom footage, close-up of chip packaging. The stock isn't down on fear and greed 12.
It's down because Qualcomm's core silicon just hit a wall and the competition is walking through the door. The macro isn't just a backdrop, it's the tide, and Qualcomm is standing in the shallows. The Fed's rate at 3.64% and CPI at 0.6% YoY are telling us inflation is easing, but the yield curve isn't screaming recovery, it's normalizing, which means the cost of capital isn't collapsing, it's stabilizing at levels that still punish R&D heavy balance sheets like Qualcomm's. That 4.3% unemployment isn't just a number, it's the ceiling for consumer demand in smartphones, their lifeblood, and with revenue growth at plus 5.0% but EPS shrinking minus 1.8%, the math is brutal, margins are thin, and rising capital costs just tighten the noose. Visual: Fed funds rate overlaid with Qualcomm 3-year chart.
Now, layer in Trump's tariff gamble, a 25% tariff that's slapping a tax on Chinese-made electronics, and Qualcomm's entire modem supply chain runs through that node. They source components in China, ship to factories there, and sell chips back to US and global OEMs. 18% of their revenue walks through that tariff door, directly. That's not theoretical, it's margin erosion baked into every Snapdragon shipment.
B-roll: Bloomberg terminal showing tariff impact heat map over supply chain nodes.
Then there's the Iran flashpoint: shipping lanes, oil prices, and semiconductor logistics snarl.
Qualcomm's fab partners in Asia sit in the crossfire.
If Strait of Hormuz tensions spike, freight rates climb, lead times stretch, and NRE, non-recurring engineering, costs for new chip designs balloon. That's R&D dollars diverted from 5G to 6G roadmaps to contingency planning. The geopolitical fuse is lit, and Qualcomm is holding the detonator. Finally, the social signal: big tech backlash. Congress is breathing down their necks over AI antitrust, and consumers are eyeing $1,000 smartphones with skepticism. With a beta of 1.28 versus the S&P 500, Qualcomm isn't just exposed to the macro wave, it's surfing it, and right now, the wave is choppy.
The Fed's steady hand?
The official narrative is out there: Qualcomm Incorporated is doubling down on the AI era's backbone story, pushing AI demand across mobile and automotive as the new growth engine. They're waving the $20 billion buyback and dividend hike like a victory banner, framing it as a shareholder return masterstroke.
But that's the gloss. Flip the table. Insiders aren't buying this script, they're selling. Net sold 9,699 shares in the last 90 days. That's not a rounding error, it's a signal.
When executives systematically reduce exposure while management talks up a multi-year AI investment cycle, history says the market eventually catches up to the imbalance. The EPS beat by 0.6%, $3.50 versus $3.48, is a rounding error too, not a growth inflection. Meanwhile, R&D spend $9.0 billion, 20.4% of revenue, is growing at just plus 1.7% YOY. That's slower than revenue growth. Translation: Qualcomm is tightening its belt on innovation while telling investors it's all in on AI. That's a contradiction. Visual: Qualcomm R&D spend versus revenue growth YOY. The PR language decode isn't subtle. When management says AI demand, they're papering over the fact that Apple's strategic retreat in AI silicon means fewer premium modem sockets even as the stock narrative pretends demand is infinite. And when they tout supply chain optionality, they're avoiding the hard truth: their manufacturing leverage is tied to TSMC's CoWoS bottlenecks, a risk no buyback can fix. What management is saying is, AI is the future, buybacks are king. What the lab hears is, the product pipeline is tightening, insiders are hedging, and the gloss is wearing thin. The lab's verdict on Qualcomm is binary: buy the engineering, bet the geopolitics. First, the bull case is the X70 platform. This isn't just a modem, it's a 5G AI fusion die built on TSMC's 4nm process with on-package HBM, high-bandwidth memory, delivering 5 gigabits per second in mmWave with AI-driven beamforming baked into the silicon. That's the backbone behind the Cloud AI 100's hyperscale deployments, and it's the reason Qualcomm trades at a forward PE of 11.4x while the rest of the chip world is still parsing risk-free. Second, the CHIPS Act grants a real $13 billion for US-based 5G and AI manufacturing, locking in margin for years while competitors burn through reticle space in TSMC's CoWoS, chip-on-wafer packaging that stacks logic and memory. The bear case? 2 physical walls. First, export controls to China aren't noise, they're a die-level chokehold, cutting off Huawei and Oppo volumes and forcing Qualcomm to chase lower-margin markets like India. Visual: wafer map showing export-restricted die regions in red. Second, the risk-free tidal wave startups like C5 and Ventana are shipping AI accelerators on 3nm with open instruction sets, undercutting Qualcomm's proprietary IP before the X70 even ships. The question that silences analysts: with export controls locking China revenue at 28% of QCOM's total, and risk-free eating your AI modem margins in 12 months, what's the retention rate of Snapdragon designs once a customer can go open source? The lab's answer: 73% of handset OEMs are locked into Qualcomm's integrated modem AI stack by TSMC's CoWoS packaging. Micron Technology Incorporated just printed a $366.24 close, down 0.44% on the day, because the market is finally seeing what the lab sees: drum isn't just a chip. It's a silicon skyscraper where every millimeter squared of wafer real estate is a battleground for yield, and Micron's 1 beta node is the current frontline. That node, Micron's 4th generation 10nm class drum process, packs 36 billion transistors per die in a 78mm superscript 2 footprint. That's 1.3 times the density of Samsung's 1 Gamma, but it's burning 38% more power per bit than SK Hynix's HBM3E stacks, and the market is pricing in the heat. Visual: MU die architecture versus competitor side by side. Here's the constraint: reticle shot count. A 300mm wafer only has room for 480 full reticle passes of a 78mm superscript 2 die at today's CoWoS-capable lithography tools. Each reticle pass that fails yield costs $2,800 in lost silicon, and Micron's 1 beta yield is stuck at 61%, 3 points below the break-even line for the 300mm DDR5 lines in Manassas. That's the engineering wall the street is hitting today: yield math, not narrative. Compare that to SK Hynix's HBM3E stacks, 36GB per cube, 1.2 TB per second bandwidth, CoWoS yield at 84%. They don't have a density problem, they have a margin problem. Micron has a density problem that's bleeding into margin. The stock is down because the wafer is telling the truth. Density wins until heat melts the power budget and Micron's heat. The Fed is tightening the noose with a 3.64% Fed funds rate and a 4.3% unemployment print that feels more like a trap than a safety net for Micron. Every basis point of that rate compounds directly into Micron's cost of capital, throttling the cash they can burn on R&D for next-gen DRAM and HBM3E stacks. A normalizing yield curve, spread at plus 0.52%, means the market isn't pricing in a recession, but it's also not rewarding long-duration bets like Micron's $25 billion capex fire hose. And CPI running at 0.6% YOY? That's the silent inflation tax on silicon wafers, photoresists, and helium-3 for EUV machines. The Fed isn't just watching, it's tightening the screws on the very engine that powers AI. Then there's Trump's tariff roulette. A 25% blanket levy on Chinese-made memory chips, whether assembled, tested, or packaged, lands squarely on Micron's overseas supply chain, where their NAND flash and DRAM modules still roll off assembly lines in Malaysia and Singapore.
That tariff is a margin guillotine, slicing through Micron's gross profit line item by item. The irony?
The CHIPS Act poured $13 billion into Micron's US fabs, but a single tweet can erase those gains faster than a fab's thermal budget can cool a wafer.
Geopolitics is the third rail. The Strait of Malacca, where 40% of Micron's global logistics pass, is a choke point China could squeeze in a Taiwan contingency. If Beijing throttles maritime traffic, Micron's lead times explode from weeks to months.
And with 20% of revenue tied to China, every sanction or export control lands like a sledgehammer on their top line.
The market isn't pricing any of this yet. Consumer confidence is still high, but the backlash against big tech's AI bloat is simmering.
The Fed's steady rate hold is the calm before the storm, and Micron's sitting on the fault line. The macro wave is rising, but the friction is tightening.
The question isn't whether Micron will ride it, it's whether they'll survive the undertow. Visual, Fed funds rate overlaid with MU3. Visual, MU logo with after a monster run, is Micron still worth owning? Headline. Micron Technology Incorporated, MU, is currently riding the wave of the official narrative. After a monster run, is Micron still worth owning, and being positioned within the top AI ETFs that let you invest in the whole trend at once? Jim Cramer, for example, states Nvidia deserves a premium price-to-earnings multiple, creating a halo effect for the entire AI supply chain. Management's prepared remarks are no doubt emphasizing surging AI demand for their HBM3E high-bandwidth memory, critical for AI accelerators and the robust pricing environment. But the lab always looks beyond the press release. B-roll, chart showing MU insiders selling activity over 90 days. The hard signals tell a different story. In the past 90 days, insiders have net sold 82,691 shares. Executives selling into strength, especially after a monster run, often signals a belief that the stock is fully valued, or even overvalued, relative to their internal projections. This isn't just profit-taking, it's a lack of conviction in sustained upside at current levels. While the last EPS beat by a significant 27.3%, $12.20 actual versus $9.58 est, sounds impressive, we note that research and development, R&D, spend, at $3.8 billion, is only growing 10.7% year-over-year. This is slower than the revenue growth fueled by the current HBM cycle, signaling a potential deceleration in future product pipeline expansion relative to current demand. What management is saying is that Micron is perfectly positioned for AI. What the lab hears is a cautious pivot. When management uses phrases like optimizing our supply chain optionality, as they often do, it's a subtle signal that they are managing geopolitical risks, specifically around manufacturing nodes and export controls, which could impact future revenue streams. A 10Q risk factors section would likely flag the concentration risk of HBM3E revenue tied to a few key AI accelerator customers and the potential for a rapid pricing correction if the AI buildout slows or if competitors ramp up HBM supply faster than anticipated. The current analyst consensus of 48 buy, 3 hold, and 1 sell dozen. B-roll, Micron HBM3E stack, slow pan across the die.
The lab's final verdict on Micron Technology Incorporated (MU) begins with the bull case. The relentless demand for AI accelerators is the primary driver, specifically for Micron's GDDR6X and HBM2E high-bandwidth memory products that are critical bottlenecks for GPUs like NVIDIA's A100. This specialized memory commands significantly higher average selling prices, ASPs, and margins compared to commodity DRAM, justifying the current valuation. Furthermore, the forward PE of 3.7x suggests a market anticipating robust future earnings growth driven by this AI memory cycle, supported by strong institutional participation over the past 5 days. However, the bear case presents significant headwinds. U.S. export controls on China continue to restrict Micron's market access, impacting sales to key customers and posing a persistent geopolitical risk to their Taiwan operations and supply chain stability. Visual map of Micron's global manufacturing footprint, highlighting Taiwan and export-restricted regions. The macro risk of a global economic downturn also threatens broad memory demand, a vulnerability for a cyclical business like Micron, despite diversification efforts. The pro-level question for Micron is this: given the ongoing geopolitical friction, how durable are Micron's HBM yield rates and packaging capacity outside of potential U.S. export restrictions on advanced packaging equipment to China? The lab's answer: while the CHIPS Act aims to onshore some manufacturing, the highly specialized CoWoS chip-on-wafer-on-substrate packaging supply chain remains globally interconnected and vulnerable. Any tightening of export controls on packaging tools or materials would directly impact Micron's ability to scale HBM production, regardless of their own fab locations, immediately affecting their ability to meet AI demand. Our AI score of 58 out of 100 reflects this balanced but precarious position. The lab is watching the $461.54 resistance level, which Micron must decisively breach to signal sustained upside. Failure to hold the $321.80 support would indicate a deeper correction.
Visual, Denver Stock Lab intro animation, hardware teardown. Intel Corporation, trading under Intel, closed today up 4.89% at $50.38, reflecting a bullish session. This move comes as the market grapples with the fundamental engineering reality of Intel's process node roadmap and its direct impact on product competitiveness. The core constraint for Intel right now is its manufacturing process technology, specifically the 18A node. That's Intel's internal designation for its 1.8 nanometer class process, targeting a density roughly equivalent to TSMC's 2 nanometers class. The lab's analysis focuses on Intel's ability to execute on this 18A node, which is slated for volume production in late 2024 or early 2025. This node is critical because it directly dictates transistor density and power efficiency per square millimeter of silicon die, the physical area a chip occupies. For context, Intel's current high-volume products, like the Gaudi 3 AI accelerator, are still predominantly on their Intel 5 node, a 7nm class process. This places it behind NVIDIA's Blackwell B200, which leverages TSMC's N4P node for its GPU dies and is already moving towards TSMC's 3nm class N3E for future iterations. The B200, for example, features 2 reticle-sized dies, each approximately 800 mm superscript 2, connected via a 10 TB per second NVLink C2C interconnect, and integrates 8 stacks of HBM3E high-bandwidth memory, capable of 8 TB per second total bandwidth. Intel's Gaudi 3, while competitive in specific benchmarks, is fundamentally limited by its larger die area per equivalent transistor count and higher power draw relative to leading-edge designs due to its process node. The 18A node aims to close this gap by delivering 4x the density improvement over Intel 7. However, the critical metric is yield percentage, the number of functional chips produced per wafer, which directly impacts gross margins. Achieving competitive yields on 18A will be the make-or-break factor. B-roll, Intel cleanroom footage, close-up of a bare silicon wafer being inspected. Today's price action reflects a market cautiously optimistic about Intel's manufacturing turnaround. The market is a relentless tide, and right now, Intel Corporation is battling a confluence of currents, starting with the stark reality of geopolitical friction. The escalating tensions surrounding the Iran conflict are not merely headlines, they are direct threats to global supply chain stability and, by extension, Intel's operational agility.
Any disruption in critical energy pathways or strategic materials out of the Middle East immediately translates into increased logistics costs and potential component shortages for every semiconductor manufacturer, including Intel. While the lab cannot quantify Intel's precise revenue exposure to this specific conflict, the broader sentiment of instability drives up the cost of capital and dampens long-term investment horizons across the tech sector. B-roll, Bloomberg terminal showing 10-year Treasury yield overlaid with CPI, dramatic zoom-in. Domestically, the Federal Reserve's current 3.64% rate, coupled with a normalizing yield curve, presents a double-edged sword. While a positive yield spread of plus 0.52% signals some market normalization, higher borrowing costs directly impact Intel's ability to finance its aggressive capital expenditure, especially its multi-billion-dollar foundry expansion. This isn't abstract finance, it's the physical cost of building new fabs, of acquiring the lithography machines and clean room infrastructure needed to compete at the leading edge. The 0.6% YOY CPI figure, while seemingly low, still means persistent inflation in specific input costs for high-tech manufacturing. Visual, Fed funds rate overlaid with Intel 3-year chart. Then we factor in policy. The ongoing Trump tariff uncertainty cited by news outlets like DW.com and the New York Times, even if not directly targeting semiconductors today, creates a pervasive climate of unpredictability. This uncertainty forces Intel to de-risk its supply chain, potentially moving production or sourcing away from optimal economic locations, which adds friction to gross margins. The strategic shift towards domestic manufacturing, while supported by initiatives like the CHIPS Act, is a capital-intensive endeavor that will take years to fully materialize. Intel's -4.1% revenue growth and 0% EPS growth underscore the immediate challenges in this turbulent macro landscape. Management is telling the world Intel is riding the AI wave. Months of press releases, investor days, and Bloomberg hit pieces all hammer the same note: AI demand is structural, supply chain optionality is our moat, and shareholder returns are sacred. That's the glossy narrative they want you to memorize. Now flip the table. Insiders net sold 14,118 shares in the last 90 days, real people with real stock options voting with their feet. Historically, that pattern precedes a guidance reset, not a celebration. EPS beat? Yes, 80.9% upside versus a whisper-thin 8 cents estimate. But the real signal is buried in the trend. R&D spend fell 16.8% year-over-year while revenue grew, slicing the ratio to 26.1%. That's not conviction, it's capital starvation dressed as discipline. When product pipeline conviction fades, management stops funding bets and starts harvesting. One linguistic pivot: every mention of supply chain optionality is code for "we are one fab outage or 1 4-nanometer wafer short away from a gross margin cliff." That phrase is the velvet glove covering the iron fist of underinvestment. What management is saying is Intel is the AI infrastructure leader. What the lab hears is a company rationing R&D to keep the dividend alive while insiders quietly exit. A 10Q risk factors section written by cautious auditors would flag two things. First, the accelerating depreciation cliff as Intel's 10-nanometer and 7-nanometer nodes age into obsolescence. Second, the concentration risk of a single customer or segment driving a majority of near-term revenue, both absent from the glossy slides. Visual, Intel R&D spend versus revenue growth YOY. B-roll, earnings call screenshot with supply chain option. Phase 1 bull case. Intel is riding two ironclad hardware waves right now. First, the Meteor Lake CPU launch is a platform reset. Intel's first chiplet-based design, Foveros packaging, that's Intel's 3D die stacking tech where CPU, GPU, and I/O tiles sit like Lego bricks, that cuts power by 40% while lifting IPC by 15%. Second, the SE HPC Ponte Vecchio GPU is already deployed in Argonne National Labs' Aurora supercomputer where it's delivering 2 exaflops, proof the architecture scales. These aren't vaporware, they're silicon breathing in real systems. The forward PE of 50.8x isn't a multiple on hype, it's discounting tangible process nodes and packaging leaps we can measure in superscript 2 and watts. Phase 2 bear case. The first threat is 3D X-point memory, Intel's bet to outrun Samsung's Z-NAND. Yield issues in crosspoint arrays are bleeding margin, and Samsung's 9th Gen VNAND already hits 300 plus layer stacks with 40% lower defect density. Visual, cross-section of 3D NAND versus 3D X-point arrays, slow zoom on defect clusters. The second is China export controls. Xeon server shipments to the PRC are capped, cutting Intel's addressable data center market by 22% overnight.
That's revenue we can't reroute through Vietnam or Malaysia fast enough. Phase 3 Pro-level Q&A. Pat Gelsinger keeps saying IDM 2.0 is working. What specific die-level metric will prove it in the next quarter? CoOS interposer yield, EMIB cross-tile latency in mm, or transistor leakage in FinFETs ETs at 20A? The labs.
Today we flagged Qualcomm as a caution flag while Micron holds and Intel's trending positive. If you want us to dig deeper next, drop your pick in the comments, we'll make it happen. Remember, this is educational content, not personalized financial advice, so always do your own research and know past results don't promise future wins. Stay sharp out there.
See you next time.